Hey there, this is Pat Ennis of ENNIS Legacy Partners. Welcome to the Exit Readiness Podcast. I'm here with co-host Walter Dial. Our mission here on the podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building a transferable or sellable business value, and then for planning your eventual exit from the business. We want to help you build a business that's sellable and then exit successfully on your own terms and conditions. If you listen to us regularly, you've heard us mention the importance of tax planning in preparing for your exit, and that minimizing taxes and planning for that is yet just one more critical reason to begin planning much sooner than later for your exit. When selling your business, the sale price, of course, is very important, and owners are often completely and entirely focused on that. But also, what's as important is how much you keep at the end of the day after taxes, after the transaction. And with the right planning beforehand, it can make a huge difference in what you keep. But again, you got to get started sooner rather than later. Today, we're going to discuss a strategy that involves qualified small business stock, QSBS, and Section 1202 of the code. The rules around QSBS are designed to give you, as a small business owner, significant tax savings, like excluding capital gains from federal income tax, but only if you meet specific qualifications, requirements, and that's what we want to talk some about today. So that's our topic: unlocking tax savings with Section 1202. Before we get started here in a second with Walter, let me remind you that this is general tax information that we're providing. You can find it on the IRS website if you want to go there and look around for it, that we're going to be reviewing. So for your particular situation, engage a tax expert, CPA, tax attorney, both, to help you with your specific situation. Okay, so let's get started. Let's jump in, Walter. But listeners, again, just in regard to Walter, if you're a regular listener, you know this. If you're just here for the first time, you don't. Walter, he's a CPA as well as a certified valuation specialist and exit planner. And so, Walter, where are we going to get started in this conversation about Section 1202? How about this? How about just a general overview of what 1202 is, and then we'll drill down from there.
Okay, that sounds good. So Section 1202, which is the qualified small business stock question, was put into the code back in 1993. And at that point, the way it worked was if you had qualified small business stock and you sold it, you could exclude 50% of your gain, which was great, except the problem was at that time, the other 50% would be taxed at 28%, and the regular capital gains rate was only 15%. So if you think about it, if you took advantage of the exclusion, you're basically paying 14%. If you didn't, you're paying 15%. So it really wasn't that big of a deal. Then until finally it ratcheted up, the exclusion percentage ratcheted up a little bit. It went to 75%, went to 75% in 2009. Then in 2010, the exclusion went to 100%. And the IRS also issued some regulations. So at that point,
What year was that? 2010?
2010. So at that point, the qualified small business stock really became, something that people started looking at. And there's been some upgrades also under this last, the one big beautiful bill. Qualified small business stock has to meet two sets of requirements. One is a group of requirements that have to be met at the time that the stock is issued, and the other requirements have to be met during substantially all the time that the shareholder owns the stock. So the requirements that have to be met at the time of issuance are really pretty straightforward. One thing, it has to be a C corporation. So that's a pretty big deal because most small businesses start off as either an LLC or an S corp because of the C corp, the whole thing with the C corp double taxation. So an important consideration is if you're the type of company where you're raising funds, let's say you're like in some type of tech field. So the idea is raise funds, spend everything on R&D for 5 years, and then get out. It really makes sense to look at becoming a C corp because number one, you're not going to have profits probably, or they're easy to control during that period. So you're not worried about the double taxation, and this does set you up for the qualified small business stock exception. And even if you're going to have some profits, Trump's last tax bill, the one back in 2017 or whatever it was, that one put in a flat corporate rate of 21%. So even the double taxation, which is controllable, isn't that bad given the flat corporate rates. So it's important when you're starting your company to figure out what type of entity you want to be. Usually it's LLC, but in certain situations, C corp might really save you a ton of money. So that's the first qualification or requirement, that it has to be a C corp at the time the stock is issued. Second one is it has to be a qualified small business. We can take a look at what that means. And the other is the stock has to be issued by the corporation. So you can't buy it from another shareholder. It has to actually be issued by the corporation. Now it can be issued to you either because you bought it, or it could be a situation where you worked for the company and they compensated you with stock, or you could be an employee who gets stock options or something and you exercise those. Any of those are going to qualify for the original issuance requirement. So, if we dig down on those a little bit, C corp, that's pretty obvious. The issuing corporation must be a domestic C corporation, and the stock has to have been issued after the original date of enactment, which was August 9th, 1993. So if you have a real old corporation, it very well may qualify, but it won't because it's too old. So it has to be a C corp. Now that doesn't mean it doesn't mean that as long as the stock was issued as a C corp, if at some point during the life of the corporation it becomes an S for a while, that's okay. The rule is that it has to be a C corp for substantial period of the time that you own the stock. Let me go back a minute because the one big beautiful bill made some positive changes. So the one thing I didn't mention was, so the qualified small business stock exclusion is limited to $10 million or 10 times your stock basis, whichever is greater. The one big beautiful bill did two things. It increased that exclusion to 15 million. Actually did three things. Increase the exclusion to 15 million or 10 times your basis and index that for inflation. The other thing it did was it put in, if you hold the stock for 3 years, you get a 50% exclusion. If you hold the stock for 4 years, you get a 75% exclusion. 5 years, you got your 100%. So yeah, that's a big deal. And that's for stock issued after July 4th, 2025. Yeah. So in order to be a small business, the original rule was that your aggregate gross assets could not exceed $50 million. The one big beautiful bill increased that to 75 million. So in order to be a qualified small business, the basis of your assets cannot exceed 50 million generally. If you're issuing stock after July 4th of 2025, it becomes 75 million. The important thing to keep in mind with this is it's the basis of assets, not the value. So you could have a company where you build up, again, let's say you're coming up with some technology. It could be worth $100 million, but you've paid less than 50 to build it, you still qualify. Now, once a company exceeds that either 50 or 75 million threshold, it's done. It can no longer ever issue QSBS. So even if it goes over those thresholds and then later goes below, it can't issue QSBS at that point. So a company can have qualified small business stock and stock that's not qualified, depending on the size. Valuation doesn't really come into play since to qualify, it's all based on the basis of the assets, not the value. So the analysis would be you'd have to sit down, you'd have to determine that the basis of the assets is below the $75 million threshold now. Then you would do a analysis of, okay, what's potentially going to be the tax on a C corp for the next 5 years, and then what are the different scenarios for sales price in 5 years, and you need to compare the cost of that. In most cases, I mean, a valuable business, a conversion could definitely make sense, but it's not. They may have to. It's going to be their CPA, maybe even a tax attorney. Now, here's the other interesting thing: if you own qualified small business stock, and I'll tell you a story. Back when I was practicing CPA, a guy that you and I both know was in a startup, and I was doing his tax return. He said, "Oh, I sold this company. I sold the stock of this company I used to be involved with," and it was obviously a startup, and he had owned it for a long time. So I said, "Why don't you go back and see if this qualified as QSBS stock?" So he went back and he said, "Yeah, it did," and it was a $4 or $5 million gain. And I said, "Fantastic. When did you acquire it?" And he literally missed the 5-year holding period by less than 2 weeks. And I think what had happened was probably the president and some other founders had their stock and they met the 5-year test. So they sold, but he probably came on board a month or two later. But if he had known, I would think they would have let him, wait a couple of weeks to date his papers. But at any rate, that's just a story. So at any rate, so one thing that's really interesting with this, one of the other requirements is the original issue requirement, which means the company has to issue you the stock, either for money or for compensation. However, if you gift that stock to someone else, or if someone inherits that stock from you, it does not lose its nature as qualified small business stock. So if you gift the stock or someone inherits it, they're considered to have received it in original issuance. So here's the planning point. Let's say you own QSBS stock that's worth, and the gain on that's going to be, the new exclusion is 15 million. So let's say the gain on that's going to be 60 million. If you gift that to your 3 kids, each of them has a $15 million exclusion, and you have a $15 million exclusion. So you could basically gift that stock in such a way that no one pays tax on $60 million. Isn't that amazing? I mean, obviously, it could be a rare situation, but think of the savings. Now, here's something that I think is important to note. We talked about what's a qualified business, and I'm not going to get into like the asset tests and stuff like that. They're pretty straightforward. But the important thing I think the takeaway is, because especially in the DC area, lots of businesses don't qualify for qualified small business stock. The general phrase I would use is any type of service business. So you're a government contractor doing services like computer consulting, um, right? Accountant, architecture, engineer, consulting, even certain businesses like banking and insurance, farming, hotel, motel, restaurants. Yeah, it's a long list. But generally, it's really set up like a lot of these things for manufacturing companies, companies that make things. The only other point that I think is important to make is, and this is not as critical as it used to be because of the new 3-year and 4-year exclusions. But let's say you own QSBS stock, but you've only owned it for 2 years and you get a great offer. You can sell that stock and you can actually do a rollover into other QSBS stock. If you do that within 60 days, you don't pay tax on your gain, and you now have QSBS stock carrying over. So that's a pretty good provision. It was really good before with the 5-year rule. Just in general, although 1202 is just like the world's greatest home run, there are lots of other tax strategies that people need to consider.